Hey, I'm Supreeth and I'll be going over this exciting tool which is exclusive to the crypto space. It's on-chain analysis and I'll summarize the key points in 20 minutes. So there's this technique that you can use in the crypto world and you can't use it for stocks. But this can give you an advantage as a trader or investor. It's called on-chain analysis and if you ask me, it's a game changer. Reading the news and playing along with technical indicators is often the tip of the iceberg as to what's really going on with any coin or token. The bulk of the crypto's bullish and bearish momentum is often happening under the hood. Analyzing blockchain activity often provides the missing context you need to succeed. So that's why today I'm going to tell you everything you need to know about on-chain analysis, take you through a few indicators I have personally used and how you can use them to your advantage. Before we dig into the on-chain metrics, I have a disclaimer to make. The video is not financial advice and should not be used as the only metric for any kind of trading or investing. Please do your own research before dipping your feet into the crypto markets. So what is on-chain data? On-chain data includes the information of all occurred transactions on a certain blockchain network, or put differently, all information written on the blocks of a blockchain. In case of a public blockchain like Bitcoin, the information is available to everyone to see. The data can be broadly classified into three different categories. Transaction data, example, sending and receiving address, transferred amount, remaining value of a certain address. Block data, example, timestamps, minor fees, rewards, and smart contract code. This is done using a blockchain explorer, and the chances are you've used one before to check if your cryptocurrency transaction went through or not. The thing is, there is much more you can do with a blockchain explorer than checking transaction confirmations. Watching the flow of coins and tokens between wallets at both the micro and macro levels can give you a better idea of what the holders of these coins and tokens are actually doing in real time. In terms of microanalysis, this involves digging through wallet addresses manually. In terms of macroanalysis, this involves leveraging various paid and unpaid on-chain indicators that don't always involve wallet activity. Let's see just how much information we can uncover about a cryptocurrency by hand with a blockchain explorer. For some of the large cap currencies like Bitcoin, Ethereum, Litecoin, Polygon, and Dogecoin, a few key on-chain metrics can be easily checked using BitInfo charts. I'll leave a link to the site in the description below. Using Bitcoin as an example, you can see that BTC's supply is quite evenly spread among the top 100 wallets. This is quite a good sign because it means that there isn't any one wallet which could dump BTC and crash the price, which is of course not the case with Dogecoin. Because BitInfo charts shows you when each wallet last sent or received Bitcoin, this can give you an idea of whether the wallet is active or whether someone's lost the private keys, that is, access to their wallet. Lost Bitcoin accounts for more than 20% of BTC's supply. It is believed to be lost because it hasn't been moved in many years despite all the bull markets we've seen since that time. Another thing BitInfo charts tells you is whether wallets belong to cryptocurrency exchanges. This is important to know because if a lot of BTC is moving into an exchange, it means people are selling, and if a lot of BTC is moving out of exchange wallets, it means people are hodling. When you see big investors, also known as whales, moving large amounts of BTC onto exchanges, it is generally considered as a very bad sign. A valuable piece of information you'll find on BitInfo charts is whether a wallet is a multi-sig wallet. As the name suggests, multi-sig wallets require multiple people to sign off a transaction before it's sent out. Now, the reason why multi-sig wallets are important is because they often belong to institutional investors, and that means you should be watching these wallets very carefully. When it comes to analyzing on-chain metrics, for smaller altcoins, you should always do your best to find as many different blockchain explorers as you can for the cryptocurrency you're looking into. This is because the default blockchain explorers for some cryptocurrencies lack a lot of critical information. Sometimes they don't show you anything at all. Now, to me, this is a red flag because if a crypto project is legit, it should have nothing to hide when it comes to supply distribution and which wallet belongs to whom, within reason, of course. Given that most altcoins are tokens living on the smart contract blockchains, you should be able to see everything. Since on-chain information about tokens is often easier to find than for the native coins, and because Most of the popular altcoins exist on Ethereum. I'll stick to etherscan.io for the purposes of this video. The company that made Etherscan also made BSC Scan for Binance Smart Chain and Polygon Scan for Ethereum's Polygon sidechain. So the information here will be widely applicable to these blockchain explorers as well. Anyways, once you've found your preferred token, using the search bar in the top right, the top accounts by balance can be found under the blockchain tab. Using Chainlink as an example, you can see that nearly half of Link's supply is held in the top 3 smart contracts, as noted by the paper icon to the left of the address. Whenever I see something like this, I typically try and find out what exactly these smart contracts are for, assuming it hasn't been noted already. This can be done by simply putting the wallet address into Google and seeing what comes up. In this case, the largest of the smart contracts seem to be for the Chainlink's node operator incentives. Alternatively, if you see that the same number of tokens are being gradually sent out at regular intervals, it's probably a vesting contract for ICO investors. You can apply the same treatment to larger wallets that aren't smart contracts to see what's going on there. Usually, these larger wallets belong to the team or early investors, and if you see tokens leaving their wallets for exchanges, that means they're selling. This is normal, but obviously not all of these whales are created equal. If you saw Ethereum's founder Vitalik Buterin sending all his ETH to Binance, you'd be wise to do the same regardless of what you're seeing in the news or in the price charts. I reckon the same goes for certain other crypto projects, and some founders have been caught red-handed trying to sell their holdings while claiming that their coin or token was heading to new all-time highs. On that note, it's important to remember that staking contracts can and often do camouflage the real distribution of a coin or token. This is because it's not always easy to track the figure out of how many of these coins or tokens have been staked, belong to each of the wallet addresses, especially if you're not using any elaborate blockchain tracking system. Come to think of it, I don't even think there are any of these tools that track these associations. This is a problem because if there are one or two whales chilling in the staking pool, they could suddenly unstake and begin selling their bags to the open markets, thereby crashing the price. Staking contracts can also have profound implications for a cryptocurrency supply, especially for a proof of stake cryptocurrency. An example here is Avalanche. Around 70% of AVAX's supply was being staked around 9 months ago, despite the fact that only a fraction of AVAX's supply was actually in circulation. This suggests that early AVAX investors were allowed to stake their coins while their allocations were vesting, and that means they were earning extra additional AVAX during that time. More recently, only around 50% of AVAX's supply was being staked, suggesting that many of AVAX's early investors decided to cash out as soon as they could. Now, in any case, the main takeaway here is that the percentage of any coin or token that's being staked is a fair, robust measure of whether people are hodling or planning to sell. This metric can be easily tracked using the blockchain explorer for that particular cryptocurrency. If that information isn't shown, chances are you'll find it on stakingrewards.com. Link will be provided in the description below. Note that the staked percentage on staking rewards does not seem to update in real time. Now, using Cardano as an example, you can see that 70% of ADA's supply is being staked, which is about the same as what it has been for the last few months. This shows an amazing amount of commitment from the Cardano community. The scary thing is that this could change quite quickly, given that the staked tokens are not locked. It can be unstaked and sold at any time, so if you hold ADA, pay very close attention to this metric. Conversely, if you hold any proof of stake cryptocurrencies with lengthy unstaking times, such as Polkadot, you'll probably have an easier time selling the top and buying the dip, assuming you're not staking too. This is because the restriction on the market-ready supply makes prices more volatile, and that can be both a blessing and a curse, depending on what the rest of the crypto market is doing, particularly Bitcoin. If you're wondering what the equivalent of staking percentage is for proof-of-work cryptocurrencies, the answer is exchange balances. Exchange balances of BTC and ETH have been in the news over the last few months. Low exchange balance means higher price volatility. What's interesting is that even though the crypto markets haven't been looking all that hot lately, exchange balances of ETH and BTC continue to drop. This means that Bitcoin and Ethereum holders continue to accumulate even as the prices drop, suggesting that what we are seeing now might be a bear trap. You can find both of these on-chain indicators on CryptoQuant and Glassnode. Glassnode has more indicators, but CryptoQuant is free. Another on-chain indicator I frequently check is the percentage of BTC held by whales. This indicator can also be found on Glassnode. As you can see here, whales sold off all their holdings quite aggressively during the March and April dip when BTC was reaching its all-time highs. Obviously, if you are focusing on the price and the news around that time, you had no idea that the rug was being slowly pulled out from under you. The good news is that if you are in it for the long haul, these short-term swings in whale activity are not nearly as important as another on-chain indicator, and that's the number of Bitcoin wallets with a non-zero balance. Though this indicator is also found on Glassnode, you can find variations of it for free elsewhere, including CryptoQuant. In all cases, the trend is clear, and the number of Bitcoin addresses continue to grow. The same trend can be seen on Ethereum's unique address chart, which can be found on etherscan.io. Now it's worth pointing out that the number seems to be peaking. This is probably because of Ethereum's extremely high gas fees, which have users migrating to other smart contract cryptocurrencies like Solana. While there are not yet any indicators which track the address growth for Ethereum alternatives, an easy way to estimate this is to see how many downloads their browser wallet extensions have. The last two on-chain metrics I want to mention today are the number of validator nodes for a proof-of-stake cryptocurrency and the number of miners and hash power for proof-of-work cryptocurrencies. One can argue that these two on-chain indicators are the most important simply because becoming a validator or a miner is a serious commitment. Running a validator node requires constant attention and thousands of dollars of investment into a very volatile coin. If you're not careful, you could even be slashed and lose some of that crypto. When you see that a proof of stake cryptocurrency is adding dozens of validators every month, this means there's some serious, very wealthy people who believe in the long term potential of this project. The example that comes to mind here is Ethereum 2.0. Setting up a validator node requires 32 ETH, which is around $96,000 for current prices at around $3,000 per ETH. Not only that, but any ETH staked on Ethereum 2.0 chain will not be tradable until Ethereum 1.0 transitions to proof of stake. Now, even with these high demands, the Ethereum 2.0 staking contract has become the largest ETH wallet on Ethereum. Oddly enough, Ethereum's proof of work hash rate also recently hit a new all-time high, despite the fact that its blockchain will soon be transitioning to proof of stake. For those unfamiliar, hash rate is basically the amount of computing power connected to a cryptocurrency blockchain. Hash rate has a relatively high correlation with the price of the coin being mined, and this is no coincidence when you consider just how much commitment cryptocurrency mining is. Setting up a serious cryptocurrency mining operation is often exponentially more expensive than staking and brings with it a whole lot of other issues related to infrastructure, namely energy and space. That's why some of the most bullish crypto news articles are those that detail the purchase of thousands of Bitcoin mining rigs. Whoever is buying them is in for the long haul, and the fact that some of the largest asset managers in the world are increasing their exposure to crypto mining companies suggests they see the same long term potential. A mining related metric that's worth watching is the amount of BTC and the number of nodes on Bitcoin's Lightning Network, which has also grown exponentially over the last year. In case you didn't know the Lightning Network, it's a second layer to Bitcoin's blockchain that proposes to decongest the network by creating micropayment channels between two parties. The Lightning Network just might be the secret to mass adoption of Bitcoin. On-chain analysis does not get nearly the amount of attention that it should, and I'll be the first to admit that I've historically neglected in my own personal crypto trading strategy. While it's easier to understand what some metrics mean for the price of a cryptocurrency, many of the on-chain indicators we have today are still in their infancy. And this can and often does lead to conflicting information. The amount of BTC on exchanges and the amount of BTC held by whales is a great example of this. Now, there are countless other on chain indicators that seem to be valuable, but I did not mention today simply because they end up not being very accurately correlated to the price movements. Even so, on chain analysis has been an anchor for me in these pressing times, and it's something the institutional investors are following closely too. It might actually be why regulators are starting to get nervous. They're seeing the exponential growth in the users, validators, and miners across all cryptocurrency networks. This adoption is expected, of course, because of what you can do with the cryptocurrency goes way beyond what we have in today's financial system, and every day is becoming an even more viable alternative. So, whenever the crypto market has got you down, pull up the number of addresses or validators or hash rate or Lightning Network nodes and remember the bigger picture. No matter how much the price tanks or how hard the fear, uncertainty, and doubt of FUD is being spread, if these metrics keep climbing, the rest is nothing but noise. In a world where data is considered as the new gold and blockchain is on the brink of transforming how value is being stored and exchanged, the relevance of emerging on chain analytics practices cannot be overstressed. Different players have emerged over the past few years, offering their users a plethora of easy to apply on and off chain indicators and datasets. It is in the nature of things that not all indicators will provide insightful data over time. Nevertheless, the on-chain analysis phenomena is here to stay and will likely to grow further along with the general adoption of the blockchain technology. I'll end the video by giving a little information about the on-chain data suppliers. I'll start with the most commonly used platform, Glassnode. Switzerland-based Glassnode is renowned in the blockchain space for its ever-expanding range of innovative on-chain indicators. The company's online platform is very easy to use thanks to a great user interface. Even with the free plan, one can access a broad set of data points. Glassnode also publishes in-depth reports about on-chain insights on a regular basis. Furthermore, users can also learn about different on-chain analysis concepts and indicators in the Glassnode's free Academy section. If Glassnode does not suit your likings, you can look into CryptoQuant. CryptoQuant is a Seoul-based blockchain data service provider that focuses on Bitcoin, Ethereum, and stablecoins. Its data, which is available via API or directly in Python, R, and Excel, can be classified into four subsets: on-chain data, exchange data, miner data, and network data. Another platform I'd like to talk about is DAppRadar. I have not used it in the video, but it's very helpful for tracking dApps or decentralized applications in real time. DAppRadar tracks over 3,000 decentralized applications in real time. The platform is a hub for accessing the rankings of most popular applications running on a distributed computer system. DAppRadar also acts as a distribution channel for developers looking to expand their reach, as well as providing them with the advertising facilities for new dApps. Thank you for watching the video till the end. Do drop a like on the video if you liked it, share it with your friends, and subscribe to the channel for more educational content.